Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be discussing Bollinger Bands. This is probably one of the most popular overlays that people use all the time. In this particular scenario, I have it overlaid on my candlestick charts. I always use candlestick charts. However, Bollinger Bands are calculated based on the closing price of each period. Therefore, a person could use a line chart and still read it just fine. Bollinger Bands were developed by John Bollinger, named after him. Bollinger Bands are volatility bands placed above and below a simple moving average. Bollinger Bands consist of a middle band with the two outer bands above it and below it. Let me draw that out for you. This is the middle band, also the simple moving average. This is usually set at 20 periods, as it is here by default. Simple moving average is used because the simple moving average is also used in the standard deviation formula. Look back period for the standard deviation is the same as the simple moving average. So if you were to go change this look back period from SMA, instead of being 20 period, but you were to make it 50, it would automatically adjust your outer lines as well. The outer bands are usually set two standard deviations above and below the middle band, at least in default. Bollinger recommends making small incremental adjustments to the standard deviation multiplier if you were going to change it for an individual security or a set trading style or a time frame, and that would be this number here. This is actually a 2.0, okay? That's basically recommended for the simple moving average of 20-day. However, if you were to change it to a 10-day period, then it would be 1.9 is what he recommends. It's just, minute changes in that situation. Longer term traders who wanted to use a 50 periods SMA or simple moving average, he recommends a 2.1 as opposed to a 2.0. Okay, you can just kind of tweak it yourself how you like it, but use small changes. A couple items you need to know before you get into how to use it for actually finding signals. You want to know as much as you can about what the Bollinger Band is just reflecting to you from the moment you look at it. Whenever you have a situation where your simple moving average is pointing down, you're looking at a downtrend. That's what that's telling you. When it's pointing up, it's telling you you're looking at an uptrend. That makes sense. And when it's exactly flat, then you know you're in a sideways moving market or something is changing. So whenever you're in a situation where you've got an uptrend going on and then you go flat, you know that that uptrend is now in question. Okay. And if you're looking at a situation where you're in a downtrend, all of a sudden she starts to go flat on you, then you know you're looking at a change of direction. That direction could continue as the previous direction, but you know at that moment something's up, something's about to change, and that's what analyzing volatility will do for you. Is typically you have two constants in the market. You have periods of expansion and periods of contracting. So you have a move that was going to the downside back here, tightened up, then advanced to the upside, tightened up, then advanced to the downside, then it tightens up, takes it a bit here, and then it does something else. It should be noted before we get into the signals that most people recommend you use multiple indicators as opposed to just looking at the Bollinger Band and determining, you see a buy signal, you see a sell signal, something like that. And they recommend you use multiples, and I would agree with that. In this situation here, I'm going to be showing you what they call an M top. It looks a lot like a double top, but it allows you to spot it by having your Bollinger Bands in place. Here you've got a situation where you are advancing, okay, and then you close way up here above this upper Bollinger Band line, right? And you pull back down and you advance again. However, you come nowhere near the upper Bollinger Band line, even though price activity is at nearly the same height as it was over here, giving you a double top scenario kind of thing going on there. It's not closing above or even touching the upper Bollinger Band line. And in that situation, you can see that volatility is decreasing, so you would expect this to probably be failing, and you would wait for confirmation by this low to be taken out. So you simply draw a line right here. If that low gets taken out, then in fact you are peaking there, and down she comes, takes that out, and there's an opportunity to you've got a signal here telling you to sell. A couple of items to note about the M top. This is a good sell opportunity here, but like I said, you want to find something else that confirms it. I would probably use the slow stotch. In this case here, you've got a high point here, lower high here. It's obviously trending down while price activity at the same period was flat. And that's a bearish divergence telling you to sell as well. So it's confirming the indication of the Bollinger Band. The M tops don't have to have, and price activity doesn't have to be like a double top, would be two nearly equal points. The M top can actually, let me clean that up, can actually have a cattywampus scenario where your first high is higher than the previous or lower than the previous. You could have had a bigger move here, and as long as it still hadn't tagged that upper Bollinger Band line the second time, then it would be showing you the same thing. Okay, it's very important when you're dealing with M tops, or what we're going to get into later, is you always look for confirmation. That confirmation is going to be a break of a low point. You've got to have that. If you get that breakdown where price actually closes below that support line that you bounced off of a moment ago, then you know that the trend is shifting, and that's an important piece of the pie. Okay, now we're going to look at what a W bottom looks like. Remember that it's based on the close of a candlestick, and that's the important part to note here. So don't get that confused when you're looking at your analysis of the Bollinger Bands. Here we have a situation where you had moved lower. I noticed that we closed below the Bollinger Band here by a pretty good amount. Then we move back up. We find that resistance at the middle Bollinger Band line, bounce off of that, and we start to move lower again. And this time we close on the lower Bollinger Band, and then we start to reverse back to the upside here. This is showing you that volatility to the downside is decreasing. You had a situation where you were easily closing well below the lower Bollinger Band line, and now here you're closing on it. So you're starting to see a decrease here. It's not confirmed until you get a breakout above this point here. Remember to use the body, the close, the highest close of that period where you had previously found resistance. And then when you get a breakout above that point, you did here, that's your buy signal. Now again, you want to use other indicators to confirm it. I would use the slow stotch. You notice here, you've got a low point here and a higher low here, showing an uptrend right there. And the corresponding low points of price activity here and here are actually trending down, showing a downtrend. That's a bullish divergence, and it's also calling for a move to the upside. A breakout of a W bottom, like I've just drawn out there for you, is typically the start of a major move to the upside, and that's an important piece of the puzzle. And make sure you get the breakout before you can say that it's confirmed. Another method a lot of traders will use, and it's not necessarily recommended, it wasn't actually the purpose in design of the Bollinger Band line, but it's what a lot of people do, and most people will start with, and that's they fade the market. Whenever you've got a situation that's moving sideways, they'll sit there and watch for an opportunity where price touches the lower Bollinger Band line. They'll look for that as a buy opportunity and a sell opportunity the next time you get to the upper Bollinger Band line, then short at the top and expect it to cover next time it touches down here. That's a method you could use as long as you're moving sideways and you've got some volatility in there to actually trade it. Then that would make sense and something you can use. But I keep a tight stop on that, because in situation when the situation changes, you're only going to trade flat for so long before somebody's going to break out to the upside or to the downside. Sooner or later that's going to happen. At the point that happens, you're going to start to see that price activity can come up there and stay elevated at that upper Bollinger Band line and start to walk the bands, just continue to advance that way. Whenever you get a really, really strong uptrend, you're going to see that price activity won't actually fall below the middle Bollinger Band line. So if you're seeing these tags thinking, hey, I'm going to sell here and it's going to come down here and touch this point, it depends on the trend that you're in. Again, just to reiterate, to get a quick little glance at the trend, just simply look at the actual simple moving average, the 20-day moving average there. If she's flat, well then you're flat. You're moving sideways. If she's trending up, she's pointing up, then you're looking at an uptrend, the start of an uptrend. If she's pointing down, then you're looking at a downtrend, that kind of thing. All right. One more item to note: if you're looking at a situation where, for example, you see this M top that we talked about before, and you get that breakdown that you wanted to see, and you start selling. A lot of guys, if they were playing the tags of the upper and the lower, so they would simply short here and then cover here is next time you touch the lower. However, you would miss all of this move. So another way of doing that is simply to stay with the trade, stay short until you see price activity pull away from that lower Bollinger Band line, which actually happened right here. Before that happened, it just kept hugging it, staying with it. But when price activity at the close could actually get off of it, then you would start to look at, okay, we're starting to get some volatility, shifting and changing the direction of the trend. So that would be an opportunity to then exit. It would get you out with a lot more profits as opposed to just as soon as you tag the lower, you're gone. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.